Welcome to the Emotional Balance Sheet, the go-to podcast for parents with multiple kids, especially those with twins, triplets, or more, who are navigating the maze of modern family life and personal finance. Whether you're overwhelmed by education or retirement planning, parenting dilemmas, career transitions, or trying to define your purpose and plan, we're here to guide you with empathy, encouragement, and expertise. Hosted by Paul Fenner, founder of Tama Capital, a certified financial planner and parent to 4 kids, including a set of triplets. Our podcast is your ally in the quest for financial peace of mind, proving that money matters, but family comes first. Subscribe now and join our community of empowered parents at tamacapital.com. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Tama may retain positions in the securities discussed in this podcast.
What does comprehensive financial planning even mean? At Tama Capital, it means a family office where lifestyle planning such as retirement, college, portfolio management, and tax prep and planning are all under one umbrella. But it goes beyond numbers. We focus as much on the emotional side of financial planning as we do on the financial side. We get you. We understand your challenges of building a family, business or career, and a healthy life. We are devoted to wealth planning for families like yours because we are you. Learn how our family can help your family by visiting tamacapital.com. What comes to mind when you hear the term farmland? For most, it's probably not an investment opportunity. But today I have the perfect guest, Rob Moore, General Manager at AcreTrader, who's here to help us change that. Rob explains why farmland is a compelling and often looked asset class, especially in times of economic uncertainty. Rob helps us unpack how AcreTrader makes farmland accessible, what sets it apart from traditional real estate, and why investing in a finite resource with rising demand could make sense. We also explore the truth about corporate farming, lease structures, returns, and how technology is reshaping generational farming. As someone who grew up in a farm town and farm community, this conversation has been a long time coming. Please enjoy my conversation with Rob Moore. All right, Rob Moore, welcome to the Emotional Balance Sheet Podcast.
Paul, it's a pleasure to be here. How are you today?
I'm doing great. And by my reaction, hopefully, for those watching on our YouTube channel can see my excitement about this conversation because we get to talk about something that is near and dear to me. It's been a part of my whole life is farmland. And I know for some of my clients or families I work with, I've talked to them about the potential of investing in farmland through a platform like yours at AcreTrader, where you're the general manager. So I'm excited to have you on to talk about farmland, why, what it is, why people do it, what should people consider about it, and get into inner workings of how AcreTrader works and how it allows advisors like myself or individuals be able to own a share of a productive farmland, no matter what it's growing, whether it's soybeans, corn, rice, cotton, you name it. And I know you had some other things on your platform too that are a little bit vineyards, for example, is one of the platforms or offerings that you guys had. And I always want to say this, like full disclosure, I am a investor in AcreTrader. I've invested in multiple farmland opportunities that you guys have had on the platform. And, I probably have a few clients or families I work with that are as well. So just for disclosure purposes, I want to get that out of the way. But again, I think what I want to get across to our listeners today, Rob, is why farmland and why should people, consider it as potentially part of their portfolio. And again, it comes back to, from my perspective of this differentiation between what a farmland asset can be versus what the stock and bond market's doing, especially as we're recording today on April 24th, and we're still feeling the impacts of this potential trade war that's about to go down.
Yeah, absolutely. No, it's a pleasure to be on, Paul. And from my end, a quick disclosure. Obviously, securities on AcreTrader.com are offered through North Capital Private Securities. Private investments are illiquid, speculative, and may result in the complete loss of capital. Nothing I should say should be construed as investment advice. That said, I'd be happy to talk about farmland as an asset class. And functionally, what we're going to talk about a lot today, I'm sure, will be diversification. Right. So what we're focused on here at AcreTrader is talking about the role that farmland may play in a portfolio that is diversified, right? Not all of your money should be in farmland, just like not all of your money should be in stocks or bonds or anything else. We really fundamentally, the thesis behind farmland and its role in a portfolio should be centered around diversification. So the underlying thesis of farmland is fairly straightforward, right? We have on this planet a limited amount of arable or farmable land. We are losing that at a fairly consistent clip to urbanization, while at the same time, we have an expanding population that we need to feed, we need to provide fuel for, and we need to clothe. So at a just core economic macro perspective, you have a supply and demand relationship that makes a ton of sense. Here in the United States, we're blessed with some of the most productive soils on the planet and in a fairly large volume. Historically, those fundamental economic conditions of shrinking supply paired with increasing demand have led to consistent appreciation of the value of American farmland. There's several ways to splice the data, but they all come out about the same. The give or take the 50-year average appreciation for American farmland, and this is USDA data is the easiest to lean on here, is about 6%. Let's call it high fives to low sixes percent on an annualized basis. So where we think about this, there's cash flow associated with it. And when we get into the specifics of offerings, we can talk through the relationship between appreciation and cash flow. But starting at the macro level, farmland is largely an appreciation play. So what we're focused on is investing in a hard asset. At AcreTrader, we do it in an unlevered environment. So we really want to simplify. I often tell investors, my goal is to be the most boring asset in your portfolio, right? This is backed by a hard asset. You can go out and stick your hands in it. It is productive dirt. And historically, farmland has been correlated to inflation. So it's been a store of value during recessionary periods. This about 0.67 is the positive correlation to inflation. And it's also performed or outperformed historically equities in periods of economic uncertainty. So when we talk about where we are today, what we think about farmland being is a hedge, right? This is something where you put your money, you want to wait. This is not a daily buy and trade type of asset. This is an asset that you sit on. And over the course of decades, in many instances, our model focuses on 5 to 10 year holds. But over the course of decades, you see that appreciation play. And again, in an unlevered environment, the risk profile is far more conservative, particularly in the alternative space than a lot of the other offerings out there. So when inflation
Rob,
rises,
can I interrupt you for just a second?
Yeah.
You've said that term now twice, unlevered. Can you explain to the audience like what that means?
Yeah, absolutely. So a lot of investment opportunities have debt associated with them. And previously we have had some development products on our platform. So for instance, a vineyard development that do have leverage associated with them. We pivoted about a year ago in our business to focus primarily on land investments that are not exposed to the production of the crop on top of them. So the way to think about this is our core product is investing in purchasing a piece of high quality farmland and then holding it. It's leased out to a local farmer. They're the ones that are responsible for everything above ground. We have a lease agreement. We work very closely with our operators to make sure that asset is taken care of and that it's mutually beneficial. I can talk more about that. But it's important for us that these are unlevered because we don't want to expose investors to interest rate volatility. This is the easiest way to put it, right? This is a investment that you are buying, or the asset entity that is buying this farmland that you are a part owner of is going out and paying cash for that farm. Again, It's not that there's not a role for leverage in this type of investing. It's that our specific model is focused on keeping that standard deviation as tight as possible. So the role that it should play in a portfolio, if you're investing through AcreTrader today, is functionally focused on reducing risk and then making sure that you are both getting exposure to the beta as farmland as an asset class, and then ideally the alpha of working with a group like AcreTrader on the back end. But functionally, we do not do levered investments. So all of the entities that we manage directly here are unlevered purchases of high quality farm ground, and they're all located domestically.
Okay, very good. So when, just like there's ups and downs in the housing market, because I think people listening to this may start to compare, okay, well, how does investing in a farm or farmland opportunity compared to like investing in my house, having my house as an asset? Isn't that the same thing? Am I not diversified because I have a property, whether it's my own or I rent or anything like that?
Sure. It's a great question. I think there's two factors here that come into play in differentiating farmland from other real estate investing. The first one is I don't deal with toilets and tenants. Right. So I think at a really core level, when you think about simplicity of the product, maybe there's some irrigation, some sprinklers, maybe there's some tile taking excess water off the farm. That's about as far as we go. Ultimately, you're investing in dirt and that dirt's not going anywhere. So the simplicity of it and the exposure to depreciating assets is considerably more limited than you find in either residential or commercial real estate investing. I think the other side of that is that standard deviation. So if you think about commercial real estate, accordions, the supply and demand move, right? You can build more houses. You can build more apartment complexes. You can build more buildings, business offices, things like that. And ultimately demand changes. So, during COVID, I think we have an excellent example over the last 10 years to see that accordion of where people are going to work and, equivalently what the impact there was on the value of those assets over time. Farmland, you can't make any more of it. Right? We're not going out and making more arable land.
Right.
And ultimately, the need for that food, fuel, and fiber is fairly consistent. Certainly, there are short-term impacts. Right now, we're seeing short-term impacts on, say, soybean prices due to their dependence on international trade. That said, the ground underneath it, and again, I want to differentiate between investing in the real estate and investing in the crop or the producer or the farming operation. The real estate underneath it could plant and grow almost anything, right? Anything within that weather pattern and within that temperature range can be grown. When we talk about the soils here in the Midwestern United States, and we take this for granted. I took this for granted growing up, how unique an asset we have here domestically in the United States. This just isn't found very many places in the world, this amount of high quality soil. So the biggest difference here is, again, just reducing that risk and then completely limiting the supply. And that supply, again, has been shrinking at a pretty fast clip for the last 100 years, effectively. And there's no signs of that turning around. We have more people. Urbanization is spreading out into rural communities. And as that happens, we're taking farm ground out of production.
Another term that you've used a couple times now, I know what it means, but again, I'm trying to always put myself in the listener that's listening to this, that's never been on a farm, doesn't know how it works. Is the word arable. Explain what that means.
Sure. So arable land is land that is fit for production of crops. And the way to think about this is obviously there's lots of different types of soil. We typically think of them as you have, loam, you have clay, you have sand, and then, you have this pyramid of soil mixes. But put more simply, there is ground that is ideal for growing crops, and then there's ground that is less ideal for growing crops. I live here in Northwest Arkansas. I have to do most of my gardening above ground because we have very rocky soil where I live. I live on top of a mountain. That's not ideal arable acreage, right? It's not as though I could cut down all the trees and then start growing high production corn here. That would not be possible on my property. There's quite a bit of rating within the United States. So again, farming has been around for time immemorial, but we've had quite a bit of farming infrastructure in the United States for the last 100 years. We started a soil survey here in the United States, and it literally began with people going out and physically walking and taking soil samples we have, over the course of the last century, mapped the entire country. It's incredible, right? I mean, you get on Acres, our sister companies, where we pull all of our data, and acres.com, you get on here, you look at a map, I click on my property, and I can see the breakdown of soils across my property. And you can see this map that we've mapped effectively the whole country in this way.
It's amazing.
It's incredible. And it's so awesome. I mean, so much of our job and my job personally is the marriage of data and research and the amount of information that we have, and then local knowledge, right? Ultimately, at the end of the day, I can sit at a desk here in Arkansas and find out a whole lot about a farm. I still don't know as much as the guy that's sitting out there farming it. And
yeah, it's definitely this weird. I'll use the word weird, but to me, it's fascinating combination of technology meets like old school boots on the ground. And I think in order to be successful in a space like this, you got to have both. You can't just, like, to your point, like, no, like, okay, this is a good farm because of the soil. You still got to go out there, see it, feel it, touch it, if you will. Talk to the local people and operators, because these are probably generational farms. These people, these families have been farming this land for decades and decades and decades, if not almost a century.
Oh, it's incredibly well said. And I think within the industry of new products that are being pushed or offered to farmers, whether those are financial products, whether those are seed products, whether those are input products, there is a graveyard of companies that did not understand the value of local information. And I think ultimately from our end, we try really hard to make sure we're marrying those. So we have on our diligence checklist when we're looking at offerings, and we look at a ton of property. So we're looking at, right now, we're underwriting less than 5% of the total farms we look at are a fit for our specific model and our specific investor class. So to put that in absolute terms, like, you'll look at 100 farms, and of those 100 farms, you may only find 5 that fit your guys' criteria to be able to go out and offer it to investors. That's correct. Typically, of 100 farms, we will do really deep diligence. We'll see, value in really getting our hands dirty on about 1 in 4, so about 25 out of 100. Of those, we may, consider 10 of them investment grade for our model, so they meet our diligence bar. And then, you put out offers, and we are not a top end payer, right? I mean, I want to offer a strong financial product to the investor. So I want to find a reason to come in below market with the seller. And I can certainly discuss some of those synergies, but functionally, we end up with, on average, about 3 out of every 100 farms we look at end up on the platform. Why does a farmer who's had his farm for generations in his family want to look to sell? It's a great question. So there's two different core groups of sellers that fit with us. And again, if you inherit a farm and you just want to get the most money out of the farm you inherited from your grandfather, I shouldn't be your first call, right? I'm not going to pay top dollar. Take it to a local real estate agent and work with them to find out where that motivated buyer may be. That's not me. I'm working primarily directly with farmers. And you bring up a great question. So for instance, the farm we have, at least right now, which is in the end of April, is a sale leaseback. So this is a farmer that has farmed this ground for decades. He knows every bit of this ground. I'll start by saying, and this is an agnostic statement, I'm not giving an opinion on this, this is a statement of fact. To be able to farm in the 21st century at scale, so if we're talking production row crop farms, hundreds of acres rather than a small, more mixed farm. And when you're talking about production agriculture, that scale has increased significantly. You need more acreage today than your parents needed, and certainly considerably more than your grandparents needed to be able to make a living, and that to be your primary job. That's just a fact. So because of that fact, farmers have a lot of set costs, right? Their equipment is a set cost. They have millions of dollars of debt or equity invested associated with that.
Yeah, it's expensive.
It's incredibly expensive. Yes. And there's a lot of overhead costs associated with that. You have an operating line that you have out. And all of these set costs allow you to farm a certain amount of acreage. So you may have the labor and the equipment and the ability to farm 10,000 acres. What that means is every acre below that, you are losing money against your potential scale of your business, right? You have the ability to farm 10,000. You're only farming 8. You have 2,000 acres that you're looking to pick up. the vast majority of farmers in the United States want more farmed acreage. Now, when you think about the cost of an acre of land, right? If you're looking in a core area, you may be spending $10,000 to $15,000 per acre of ground. If you need 5,000 to 10,000 acres to be a profitable farmer, the odds are you don't have the standing capital to go purchase all of those. So, and this is not new. Again, there's some misconceptions outside of the ag community that leasing ground is new. It's not. Farmers have been leasing ground for as long as they have been farming. And ultimately, you have a split between ground you own and ground you farm. The operator that we're working with right now on the Waterbury farm, which is an individual who wants to sell a piece of farm property so he can buy something that is more a fit for his operation, closer to home, more a fit for his long-term growth of his business, but he doesn't want to lose the right to farm this other acreage. So he wants to do a transaction where he's selling ground and then going out and buying more ground. This is an expansion of business if he can maintain operational control over that original farm. So he came to us, and our model is very straightforward, right? It's got to be a win for the farmer and for the investors. And so he said, look, if you're willing to sell this ground below market, we will in exchange give you a below market lease and give you long-term control over that farm. So you continue to operate it. You continue to profit off of that. We even put in purchase options with farmers where on the back end, when we go to sell the farm, if they want to buy it back, obviously at market rate, but if they want to buy it back, they have that option. So the farmer steps in and says, great, I can maintain operational control. I can get some equity to go deploy into the growth of my business. And then what I do is turn around and set up an entity where investors, public investors, can come, and our minimums are usually $15,000. So minimum of 15 grand can invest in an entity that does one thing, and that is buy and lease that one farm to that one operator. So, farmers sometimes sell to move money around. 1031 exchanges are a huge part of our industry, right? This is a tax shelter functionally where if you're selling real estate and then buying more real estate with those proceeds, it delays your cap gains tax. That is a tool that a lot of farmers use to be able to expand their operations. So one is operation expansion. We get a lot of calls from farm families that the next generation decided not to move forward, but wants to sell in a way that the operational control stays with somebody that is part of their network. So for instance, you get a call from an individual that says, hey, my parents have passed on to me 2,000 acres of farmland. It is currently farmed by my cousin, neighbor, etc. I need to sell out. I don't live in rural Iowa anymore. I live in, St. Louis, San Francisco, Orlando, wherever that place is. I need to cash out of this investment, but I really want to make sure that this stays operationally with my cousin. So again, same idea. We say, great. If it works for the investor on the price side and it works for you and your family on the operational side, then let's find a way to work together there. The third common call that we get is operators that are getting close to retirement, right? Farmers typically can come with a 401k and health insurance, right? This is not the type of, these people own their own businesses. Common misconception is that family farms are disappearing. The vast majority of farmers are family farms, right? Now they're larger. I'm glad you're bringing this up, Rob, because I think people will read headlines about family farms disappearing, the Blackstones, the BlackRocks, these big private New York equity companies coming in and buying all the farmland in the heartland of America. So I wanted to get to this topic. So I guess now's the time. Yeah. So the data does not agree with that statement. 70 to 80% of farmland transactions are still bought directly by farmers. And while certainly the scale is occurring, so there are less farmers and farmers need more acreage to maintain their operations. This efficiency has occurred in effectively every industry over time. Farmland has been honestly a little behind a lot of the other real estate asset classes for several reasons, some of which are the fact that families historically have stayed in that area and taking on that business. That's becoming less common. That said, the farms that are expanding and taking on more acreage and remaining profitable are still family farms, right? They're larger, certainly, but we're still dealing with families. I don't talk to BlackRock or Blackstone about buying and selling farms further, right? That's just not a thing. There's some institutional presence. So I would not consider us institutional. There are individual institutional groups that are investing in farmland. This is with, school pension money, things like that. That A has been happening for several decades, and B represents something like 1 to maybe 2% of the total industry. This is still largely a local industry. And there's also this misconception sometimes that external groups are coming in and increasing the price of farmland, right? We're going out and then jacking the price of a farmland and pricing farmers out of that. To be clear, as an investment professional, I have a responsibility to the investor to make sure that the purchase price I'm coming in at is below market, right? We're not at market or above market buyers. I'm looking for a way to meet somebody else's need and get the investor in at a favorable price. I'm never paying top dollar. And the vast majority of institutional groups, I think, have a similar thesis and fiduciary responsibility. So the price of farmland, the tip of that spear, is driven locally. And ultimately, if you farm next door to that farm, okay, you're saving money elsewhere in your business. You're going to be much more motivated to push the value and price that you'll pay for that farm next door than, person sitting in an office here in Arkansas. So again, there's just some common misconceptions about the state of the industry. It is certainly consolidating, but it's consolidating into family farms that are growing, not into, large institutions or people and businesses, buildings in New York.
How much does the commodity itself influence the price of the farmland? Like if corn prices are going, sky high, or they're like bottoming, does that have an influence or factor in the price of the land itself? Sure.
In the near term, certainly there's some impact, right? I mean, the price in the Midwest is the easiest example here because it's a fairly homogeneous crop mix. It's primarily corn and soybeans, right? So in a corn and bean region like the Midwest, certainly farmer profitability is going to drive competition in the market, and that will be tied to commodity prices, right? So if corn and soybeans are up 1 year, then there's more money in farmers' pockets. They're more likely to go out and try to buy a farm. More competition in that real estate market will drive up prices. Certainly, in the very isolated instance. That said, over the course of 5 to 10 to 15 years, it's largely uncorrelated, right? Ultimately, commodity prices are going to do this, and there are businesses that focus on trying to time those markets and play them and hit the highs and the lows.
Impossible.
Oh no, I do not envy those people, and I don't know how they sleep at night. It's exhausting. I do not try to time the market. And to be very specific, right, I'm focused on making sure that purchase price is favorable today. And again, historically, if you spread that out over the course of years, so if you don't think about this like a stock where you're watching it every day, farmland price is not like that, right? The idea is that smooths out over the course of a decade and historically has. Now, there are potential positive impacts from action that impacts commodity prices, but a lot of times, and I've been hearing this a lot recently with tariffs and potential trade wars, there's this fear of, what happens if the bottom dropped out of corn and soybeans, or what happens if we stop producing corn and soybeans? And for a lot of reasons, that doesn't make a ton of sense, right? We're energy dependent on corn in particular right now at a pretty high level.
Right.
But let's take that all the way to the conclusion. Let's assume for some reason as a country, we pivot away from some of those core grain crops. Well, the only reason that we grow almost nothing but corn and soybeans in the Midwest is because it's some of the best soil on the planet. It can grow just about anything. It just so happens that's the most profitable crop for people to grow. That's what the infrastructure exists. We have all the crush facilities. We have the transportation route set up. We have the Mississippi River running right through the middle of it to the Gulf of Mexico. And so ultimately, the underlying asset is where my focus is. And the value of that asset is not dependent on any specific crop type. It's just dependent on us continuing to eat. And at a core fundamental level, I feel much more comfortable with that and tend to distance myself from any of those short-term changes due to commodity prices.
Yeah, I think that's another reason why, growing up on a farm, and my story is similar to one of the examples that you laid out. Is like my grandfather, didn't want to farm the land anymore, but he certainly didn't want to sell it, so he leased it to another farmer that had the scale, to be able to farm more acreage. And then obviously like when he passed, then the farm got sold. But going back to a topic that you mentioned is there's two components to the investment, the return side of being part of a farmland opportunity. Can you explain what both of those are for us?
Absolutely. So, one side is appreciation, which we've already talked about some, and is really the
which would be no
driver
different than like your house appreciates.
Yes, that's correct. Yeah. I mean, again, historically, we have a limited supply. That supply is shrinking. Demand has been increasing. Over time, historically, that has appreciated. And again, you can even include, the only real quote unquote crisis we've had in the farmland real estate marketplace was the mid 80s. You can include all that data. It doesn't move the average, right? I mean, ultimately it returned to the mean. That ground is appreciated, again, give or take 6%, let's call it. That's one side and the primary focus. So, any ability for us to generate alpha from buying under market is what we will favor over anything related to cash flow. That said, cash flow is the other side of that equation. And when you think about cash flow from an investment in farmland, it's very important to adjust for risk. So, I'll state up front, typically if you're investing through AcreTrader.com, cash flow is going to be on average between 2 and 3% annually. Right? This is not a high cash flowing, certainly in today's environment. Now, obviously, that environment cycles and changes over time, and you can compare that to whatever, money market or bond product that you're looking at. That said, ultimately, that's not what the focus is. Focus on the appreciation. The other side of the cash flow equation is the consistency and security of that cash flow. So certainly you see a lot of really high projected returns investing in particularly commercial real estate. And there are some great opportunities there. That said, if you look at the standard deviation of actual returns, it can just so happen that you have to sink a bunch into CapEx and there goes your cash flow. It can just so happen that your tenant walks on you, a bathroom, bathrooms and tenants are the things we avoid. In farmland, the farmer is paying rent regardless of what's produced on the farm. This is a very important distinction as an asset class. So as a country, right, we have always tied food production to national security, which is one of the reasons that we have a very robust farm bill that subsidizes insurance, crop insurance for operators. And this is important. And to be clear, something that we should all know about, right? That's a huge amount of money that we're setting aside at the federal level because we believe that food security is important for us as a country. What the trickle down impact of that is that insurance allows farmers to go out and lease ground and plant their crop. Again, it's very capital intensive on the front end. And then if a hailstorm comes through and destroys a chunk of their crop in 1 year, they're going to be made whole for that. What they aren't going to do is give up access to that acreage. So our rental rates on farmland, our lease rates are paid upfront and regardless of crop production. Now, again, I'm focused on the purchase price. So I want to buy low and I want to lease low. I want to be a discount to market that incentivizes farmers to work with me. And to be blunt, it makes ethical and financial sense. If you're working with an operator and you align those incentives, then they're going to take better care of the assets that the investors are invested in. And then ultimately, you're going to find a symbiotic relationship that makes sense for both sides. The farmer is responsible for the above ground production and oftentimes will work in a shared upside incentive, right? So we have a flat rate. So that clip, again, 2 to 3% should come on an annual basis. Then oftentimes farmers will say, okay.
That's what the farmer is paying to lease the land.
That's correct. Yes, that's just for the access. Yep. And again, I want to discount that as much as possible. So oftentimes a farmer will say, okay, I can pay $350 an acre rent. And I'll say, okay, great. What if instead of $350, we make that assumed payment, the base payment, $325, but you agree to share with investors on good years. So what we do is we have what's called a flex lease where the farmer then goes out and says, okay, this year I had 200 bushel corn and corn's at $5. So my gross incoming revenue is $1,000 and I agree to pay the investor 36% of that. So then now at the end of the year, they paid $325 up front. At the end of the year, they pay the difference between that and $360. Now, on a good year, the investor sees upside. So instead of getting that $350, they now get the additional $10 per acre. On a down year, their basement, their floor is capped at that $325. And they know we're not stretching this farmer for a couple extra bucks on a year where commodity prices or yields are bad. And to me, that's a win-win for everybody. And, and from our end, we'll always underwrite to the floor. So none of our modeling or underwriting will ever do any financial assumptions based on that upside. We just see that as icing on the cake and another way to incentivize both investors and farmers to see each other as partners rather than adversaries. Right? A lot of the investing world outside of farmland is adversarial. It's focused on this sort of, how do you contract against each other and get the most out of the, one side, management side or the ownership side. And we see it the exact opposite, right? In a boring, long-term, unlevered investment, I want symbiosis. I want compatibility between me and the partners we're working with, particularly because I want local expertise, right? I can know everything in the world about farmland and farmland investing. I don't, to be clear, but I could theoretically know everything. Sitting in an office in Arkansas, I am incapable of professionally underwriting the farms that we look at. I can get about 70, 80% of the way there. I need a trusted local professional. We pay a chunk of our fee. We charge 75 bips annual management. We pay, honestly, often a third of that to a local farm manager. I want a third-party agronomist that has no dog in the fight that will go out and give me an honest answer. But I want farmers to feel like they can give me honest feedback, right? If there's a need for more drainage tile, if there's an issue on the farm, I want them to tell me because the value of that asset is so important to both sides of the equation. And ultimately, if I can be competitive on what I offer on lease terms, that's going to ultimately increase the protection that I have or the knowledge that I have that if there's something that needs to be addressed, I'm going to know about it. And again, all of these are instances where we're trying to limit risk. I am not trying to quadruple your money in 2 years and there's a chance you'll lose it all. That is not my model. I want to be you read the report every year, you're interested to see what's happening, you're learning about agriculture through reading the reporting and going through the financials. But ultimately, this is a passive 5 to 10 year investment. This is a sit it and forget it investment where we're focused on taking care of the asset. So not only do you get the participation in the appreciation of the asset class, there's a bonus from then selling a better asset than was initially purchased.
Well, I love having these conversations with you, Rob, because I learned so much every time we talk. And I think this is probably just the tip of the iceberg in trying to educate people on the ag industry in and of itself, the inner workings of it, and how a company like AcreTrader can be a part of, an investment portfolio like I do for my families here at Tama. In closing, is there anything we haven't touched on or missed that you would want to stress to either explain more about the ag industry, what you guys do at AcreTrader, or like from a investment standpoint?
I certainly I could wrap a bow on the industry or the investment, the asset class in several different manners, but instead I would put out a query. And I've sort of changed my approach here in the sense that investors that are doing things like getting on the internet and looking to diversify their portfolio, whether this be into, any form of alternative investing, and this is becoming a more often commonly recommended thesis amongst advisors, folks like yourself, they're looking at, okay, it's not just the traditional stock bond split. You need to think outside of that. My big push is when you begin doing that research, when you look into this space and see what's available and look at potential partners, ask a ton of questions, right? We at AcreTrader, you go to AcreTrader.com, you can, with a couple of clicks, set up a call with me directly, and I will pick up the phone. If you call our office, we'll pick up the phone and talk to you. Ask a lot of questions. We put full financial models up for all of our offerings. We put them in Excel. We allowed you to download and break them. And I think it's really important because there are a ton of opportunities out there, and a lot of them are excellent. And as you think about what diversification looks like for your portfolio, particularly in the alt space, the risk profile on those variables is huge. You have a huge range of opportunities available to you. And it's important not to think about alts as I want 10% in alts. What you need to think about is I want this percentage in this risk profile. And if I can access it through alts, great. And if I can access it elsewhere, great, right? And so for farmland, again, my thesis is it's time for a boring investment. Somewhere in your portfolio, I see a strong role for a boring investment that is simple, that is unlevered, that boils it down to a very, very simple thesis, and then plays as a hedge within your portfolio to then protect your capital over the long term. That's the role that we look to play, and we look to do so as transparently as possible. And again, I think that's my general takeaway for the asset class. Ask a lot of questions of all of your advisors, right? Call Paul, ask a lot of questions of Paul, and then ask a lot of questions of the people that are managing your money. It's important that we're held accountable for what we're doing.
So two things just popped in my mind. One is a statement, and one's a question, a follow-up question on that. Is, look, you guys have competitors. There's other companies out there that do what you do. And when I started working with you guys, I think 2 or 3 years ago, I did my own due diligence. And the one thing that I think really were the tipping points for me and partnering with you guys were two things. One, you always picked up the phone when I called you, and you would never dodge a question. You would always give me a straight answer. And that, without saying, is immensely helpful, and to build that reputation and that relationship. Just like you've emphasized, I don't know how many times during our conversation, this relationship that you have with the farmer. You want it to be a win-win for both of you. And then the other piece is what you just said is you provide me as the investor, whether I'm doing it on my own or doing it on behalf of one of the families I work with at Tama. You provide me with the Excel models. Like, I can see all your data. I can see all your assumptions, and I can poke holes at it. Again, I can pick up the phone and call you and ask questions, which to me was a sign of a great relationship and to be able to build a partnership. And I love how you keep pounding the table on consider this as risk management. And that's another avenue of why I like this asset class and how I view it and how I kind of strategically position it within portfolios that I manage. So that was my statement. My question, which I want to make sure I ask this, is when people are considering, like, say, making the investment, like, is it in a taxable brokerage account? Is it in a IRA, like in a traditional or Roth IRA? Can they put it in that? Obviously, you can't put it in a 401k, but can people, because a lot of people maybe not have money in a taxable brokerage account, but they could have it in an IRA. Can you walk us through that?
Yeah, absolutely. And I certainly appreciate the feedback for us. I think I take more pride in being transparent than I do in our historical returns. And I'm very proud of our historical returns. I take more pride in being the most transparent in the marketplace. And again, I hope that we always honor that don't dodge hard questions. I encourage investors, change all my assumptions and see what the outcomes are, and then call me and ask why I made those assumptions. So I really appreciate that. Regarding structure, you can see everything that we do with an email address. We do not firewall people from access to our information or data. And actually, we try to go the extra yard. I had somebody ask me yesterday, we talk about the appreciation of farmland, and somebody said, can I have that full data set? I said, sure. And down there, went to the USDA, got the whole thing, sent an Excel sheet with every piece of data dating back to 1911. Said, knock yourself out. Would love to talk to you about this. Should you run a different set of calculations and discuss why you did that versus a different one? Once you set up that account, which takes an email address, then you can get in and set up actual investment accounts under that login. And there's several you can do. The individual would be your standard. I'm just going to put this money in. We have quite a bit of the investment activity on our platform is through self-directed IRAs. So we work with several custodians that we actually have integrated into our platform. So you can complete docs for both sides in one workflow. So self-directed IRAs are a very common investment vehicle for us. We do a lot of entity investing. So you can invest through, as a U.S. citizen, resident, or U.S.-based entity, you can invest. So if you have an LLC or trust account, we do a lot of family trusts that invest through us. We also, honestly, we can do solo 401ks. We can do, checkbook IRAs. That's a different avenue you can go. And then ultimately you can manage all of those under one login. So a lot of our investors, particularly the investors that really like the diversification aspect, will diversify across different accounts. So maybe they do some investing through their individual accounts. They do some investing through their SDIRA account. And then again, trust accounts. Trust and SDIRAs are our two most common non-individual account types. And again, it can be a pain to navigate all of those different accounts and what's needed for them, which is why, again, I default to, if you run into any problem on our platform, pick up the phone and call me. And I'd be more than happy to walk you through how to navigate those. And then you'll receive, K1 for every investment on an annual basis. So then from a tax standpoint, we put out, over 11,000 K1s last month.
Yes.
And
that's another thing is I appreciate you guys get those out actually on time, because as being a tax preparer, I had one family, I won't name their names. They were waiting on a K1 until April 15th. And as soon as they sent it, I was able to file the return. So hat tip to you guys about getting those out. And to your point, like that's one of the things that I pride myself on being a family office advisor and running TAMA is I try to make it, you guys make it easier for me as an advisor. And then I turn around and make that easy for the families that I work with, as far as like having that one login and being able to manage, these different opportunities for families. So
yeah, absolutely.
Well, Rob, I'll be sure to put in our show notes the link to AcreTrader and your LinkedIn profile. But I can't thank you enough for, I think, this first conversation on agriculture investments and farmland. And I'm sure there'll be more conversations to come. But I appreciate you being on and walking this through this with our listeners.
Absolutely. Thank you so much, Paul. It's been an absolute pleasure.
So before I wrap up, I just want to reiterate the fact that I am an investor in AcreTrader. I have several TAMA families that are looking at investing in AcreTrader opportunities as well. So I didn't want this episode to be a sales pitch, if you will, for the AcreTrader platform. However, I am a believer in having diversity within the portfolio. And so I think having farmland and being able to access it without actually going out and buying a farm on your own is a really diversified way of getting exposure to an asset class like this. And that's, I think, the main thing that I wanted Rob to explain is how AcreTrader, how investing in farmland can help diversify a portfolio. Another key point is, hopefully this came through loud and clear, is the real relationships and transparency. Like AcreTrader, I decided to partner with them over other platforms I spoke to because they were always there to pick up the phone. They were there to provide additional details and answer any questions I have. And as Rob stated, like they're looking to provide win-win opportunities, not only for investors, but also the local farmers, selling or leasing their land back to AcreTrader and us as advisors. And I think that farmland can be looked at as a boring, no spice, no excitement kind of investment. But sometimes that's the perfect investment we need to help complement our investments in stocks and bonds and ETFs. And so I wanted to have an expert on that would go into some of the details and explain this in layman's terms so that anybody could really understand what it is. That's all for this week. We'll see you next time. Now that you've made it to the end of another great conversation, are you looking for more? If so, head over to tamacapital.com, where you will find all of our conversations. Use the search feature to find the topic or guest you would love to learn more about. Also, don't forget to make someone else's day by sharing our show. Thank you so much, and we'll see you next time.